Up this morning and reading the Wall Street Journal, will find maybe another reason to get upset. It seems like the credit rating agencies, S&P, Fitch, and Moody's, the very companies really often blamed for fueling the financial crisis with their overly optimistic ratings, may make out big under the government's initiatives to thaw the credit markets. That kicked off yesterday with $7 billion in bond deals. Let's talk more about this and the credit rating companies. We're joined now by Mark DeGennaro, Gruppo, Levey and Company Managing Director. Mark, welcome to Money for Breakfast.
Thanks for having me.
All right, tell us the story. Should we be upset about this?
I think we certainly should be upset about this. These rating agencies made a lot of money rating debt securities, and they were just wrong. And now we're in a position where on the TEL program, the government's got to go back and get two out of three agencies to rate securities before it's going to put up the money to loan in these private public partnerships. And there's no assurance that the business models have changed at all.
So basically, a lot of the debt that is being issued either directly under or in accordance with some of these taxpayer-funded plans is going to be rated by the rating agency. It has to be. Legally, it has to be. So they're going to get huge fees.
They are. And I don't know if there's been any change in the compensation, but typically the way it works is these agencies get between $40,000 and $120,000 per $100 million bond. So when you think about it, if the TEL program ultimately ends up being $1 trillion, that is a lot of taxpayer money going to these agencies. And the critical issue here is that there's no assurance that they've actually changed their business models in terms of how they judge the bonds. Do they base it just on historical trends and patterns in the mortgage area, for example, historical home pricing and trends turned out to be completely
Well, you know, AIG is the best thing that ever happened to S&P, Moody's, and Fitch because it took them off the front pages, right? I mean, these are firms, the credit rating agencies, which, by the way, AIG could not have insured some of these swaps and all these other things unless they had a rating on it. So maybe, you know, some of the finger pointing in D.C. might be a little bit mislabeled. Do you agree with that?
It could be. I think right now, I'd step back from the whole thing. Right now, we're in a situation where we're starting to do some finger pointing. We're starting to look down into the details of some of these programs. We're starting to look at executive compensation and things. Bonus pay is a big issue today. I think we need to step back from the whole issue and say, where are we in solving this problem? And what have we actually done to unthaw the credit markets?
Well, what have we done? Because Congress, Mark, is spending, and you'll pardon my cynicism, I know it's Friday and it's early, folks, so I apologize for it, but what the heck? You know, Congress is spending so much time in hearings, so much time trying to be retroactive, so much time trying to, you know, do populist things like tax bonuses, which I'm not saying they shouldn't. Who knows? I don't know. I'm a taxpayer, too. But
so am I.
You're right. We're not solving the problem.
The problem is still there. You've still got the big financial institutions with a lot of these toxic assets on their balance sheet causing liquidity concerns, and you're still not getting money to businesses and consumers who need the cash.
And as we pointed out, I mean, the AIG bonuses are 1/100% of the total money, less than that, actually, that we have put into AIG and some of these other banks. But yet that's getting all the headlines and dominating all of, and they're holding special sessions and writing legislation, when in the meantime, the credit markets, as you said, are still struggling.
Yeah, and we really need to focus on that. We're not going to come out of this crisis unless we are very focused on the issues that really need to be addressed today.
Quickly, what's the number one thing Congress should be working on?
Congress should be working on basically making sure that these credit markets thaw. That was the problem in the Great Depression. It's the problem here today. We need to make sure that basically banks are in a position to loan money to businesses and consumers to get the economy rolling again.
All right, Mark DeGennaro, Gruppo, Levey and Company. Mark, a pleasure. Thank you very much. Have a great weekend. All right, let's head now over to Charles Payne with Charles.